Welcome to the Market Structure Report for the week of June 8, 2026. Today we'll recap the 4 Sigma Friday sell-off and discuss the catalysts that will decide the tape this coming week. The week ahead is packed with 4 key catalysts. We have Oracle earnings on Tuesday, CPI and PPI data on Wednesday, the SpaceX IPO on Friday, and ongoing developments in Iran/Hormuz throughout the week. Our overall outlook remains cautious to bearish. 4 numbers summarize Friday's action. A negative 5% Nasdaq drop. The VIX odds flipping from 95% to 85% for a sell-off. A negative 1 on the 3 p.m. tape score for both SPY and QQQ, and the SPY refusing to reclaim the 22-day average at 745.84. In Act 1, we dive into the anatomy of the sell-off. We will analyze the magnitude, the shape, the 3 p.m. tape, the candle formation, and the key market levels. Friday's nearly 4 standard deviation event was a tail event, signaling institutional repositioning, not mere retail noise. This character of institutional distribution remains locked, regardless of any short-term bounce. Despite the magnitude, the index masked the true underlying action. Dropping to a 1-minute chart reveals a near-perfect 45-degree angle, indicating mechanical selling by desk slicing large orders over the session. The 3 p.m. tape confirmed the institutional distribution. Both SPY and QQQ closed red from the 3 p.m. mark, scoring a negative 1 and negative 1. Buyers failed to defend the close, which is a key indicator of market control. Friday resulted in an inside day doji, signaling uncertainty. The price stayed below the 50% line with a longer upper wick, suggesting a quiet bearish lean. We must respect this box and wait for a clear move beyond the inside range before trading. We look for 4 specific triggers to confirm a directional move out of the range. A clean break and hold below, a failed breakdown followed by a reclaim, an engulfing print at the edge, or a gap beyond the range. On the level map, the index is below the 12 and 22-day moving averages, riding the 55-day. Overhead resistance is strong, and losing the 55-day would signal a character change. Downside support rests at the 700 put wall. There are 2 overhead gaps at 7,584 and 7,610 that can resolve in 3 ways: gap and go, gap and fill, or the most punishing, gap and trap. We wait for confirmation to avoid the trap. Act 2 details our trading framework, index to sector to stock. We start with the overall market, sort the sectors for strength or weakness, and then identify the leading stocks within the best performing sub-indices. This funnel approach, from index to sector to subsector to stock, ensures that we are trading names that align with the market structure. The index provides the baseline, and sectors filter for relative strength. Our sector scan shows this was a rotation, not a clean risk-off event, with an inflationary tilt. Leaders include semiconductors, oil and energy, crypto, and cannabis. Laggards were defensives like utilities and basic materials. The sectors that led were cyclical and energy tilted, reflecting an inflation theme. Defensives lagged, confirming that money was not running for cover, but rotating. The sector signaled inflation before the data printed. The semiconductor group remains pivotal, but you must know which semis are strong and why. SOX is stronger than SMH, as SMH's 2x NVDA weight distorts the read. The equal weight ESOX held up better than the AI-heavy ASOX. Relative strength is crucial. We focus on what institutions are buying, not the market's direction. Micron held its 350 close print, showing institutional defense, and popped after hours. AVGO, however, was capped, setting a weaker tone for the day. The 350 p.m. print is the most reliable intraday tell. If a name refuses to break down when the rest of the tape is heavy, it indicates institutions are defending it. You only need to respect that they are defending it. The reason is secondary. Act 3 focuses on the catalysts for the upcoming week. We face Oracle, CPI, the SpaceX IPO, and the Iran situation, creating 4 landmines in 5 sessions. This demands a trading, not investing mode. The calendar forces a short-term trading approach. Key events include Oracle on Tuesday, CPI PPI on Wednesday, and the SpaceX IPO on Friday. The sequencing is a trap. Soft Oracle to hot CP. I could compound the liquidity drain. For Oracle, we watch the spillover to the AI and capex complex more than the print itself. Decide the if-then reaction beforehand. If contained, stand down into CPI. If weakness spreads, fade strength in related names like AMAT and LRCX. Our inflation setup leans hot into Wednesday. Using the average price method, crude and gasoline averages are higher month over month. Crude averaged 93.5 in April and 95.5 in May. PPI is also expected to accelerate. The SpaceX IPO creates a liquidity drain risk for adjacent space names. This marquee IPO pulls capital out of existing names. Stocks like ASTS and UFO are at risk of losing key structural levels, setting up a risk map for potential short trades. When ranking space shorts by structure, ASTS is the cleanest with a lower low under the 22-day. PL is already broken. RKLB is vulnerable but coiling. UFO is the floor. Losing its 55-day average would collapse the complex. Act 4 covers the technical signals, including the VIX flip, wave count completion, stacked divergences, and macro fuses. When these signals converge, you must pay attention. The VIX model, which correctly predicted the Monday/Tuesday bounce, has now flipped. AVGO surge greater than 20% on Friday gave 95% odds of a bounce. Monday's greater than 10% VIX fade flips to 85% odds of a sell-off in the next 2 sessions, pointing directly to Wednesday's inflation data. This VIX model is based on historical probabilities, not magic. A sudden collapse in the VIX signals complacency returning too fast, historically resolving with a pullback. If the next 2 sessions do not sell off, the signal resolved without paying. Technical confluence strengthens the thesis. The 5-leg wave count appears complete, running into major resistance. Multiple oscillators, including MACD and RSI, show stacked divergence. If wave 1 and 4 overlap, the count is invalid. We see divergence across 4 key oscillators: MACD, RSI, Awesome Oscillator, and Money Flow. These are warnings. For confirmation, the oscillators must push and stay negative, especially the Awesome Oscillator. Divergences can last, so wait for confirmation. On the macro side, crude oil is coiling in a continuation triangle, holding the 90 pivot, and set to resolve higher towards 119. The Iran fuse, ceasefire violations and Hormuz risk, keeps a bid under oil prices, feeding the inflation narrative. We are closely watching the 10-year yield and the critical 5% line. A break above 5% would reprice the Fed from will cut to can't cut, which historically creates fear in equity markets. This is a crucial macro overhang. The Strait of Hormuz situation presents a priced peace problem. The market priced an orderly truce extension that historical precedence doesn't support. The self-reinforcing chain links geopolitics to crude, inflation, yields, and ultimately equities. Historical patterns from 2000 and 2007 show that market tops often rhyme with inflation scares, whether from overheating demand or supply-side oil shocks. The current market shares elements of both templates. In Act 5, we outline the plan. The regime has shifted from trending to non-trending. The trend playbook stops working here. We must pivot to a range playbook. Remember, scalp, don't swing. When trading a non-trending market, our approach shifts. We prepare for 3 scenarios: a bear break below the box, a base chop inside the box, and a bull reclaim above the box. Chop is the default. Trade the edges. 6 rules govern a non-trending tape. Zoom out to avoid being chopped up by noise. Scalp. Don't swing. Watch the 12-20 seconds crosses for signals. Always define your invalidation before entry, and never short a dull market. A major risk is the broken state of megacap stocks Apple and NVDA. Together they represent about 1/6 of the tape. You can't sustain a durable index rally with these 2 major weights dragging below their key moving averages. For Apple to repair, it must reclaim the level it rug pulled from on real volume. For NVIDIA, repair means a sustained 12/22 cross-up. Until then, fade rallies, as the index math stacks the deck against bulls. We now provide a quick reference for the key levels discussed throughout the video. If a level breaks, the thesis tied to it changes. This page provides a summary of the watch list at a glance for the week ahead. Review the catalyst reaction map. It is vital to decide your reaction before the data prints. The plan made in calm is superior to the trade made in fear. Our methodology relies on the 7 tells we weight most. Currently, 6 of 7 signals lean bearish, with the 7th, the VIX, having just flipped to join. Confluence of signals earns size. The numbers in this video are derived from our live market structure session, analyzed through the 3-pillar framework: macro, fundamental, and technical analysis. We trust the process because it is anchored, falsifiable, and repeatable. Every thesis names the number that proves it wrong, ensuring disciplined execution. The bottom line: Friday was institutional distribution. We enter a 4-catalyst week with a bearish lean. Scalp the range, fade the extremes, and only press swings with clear structural confirmation.